Chapter 16, Title Closing and Escrow. Closing is the process of completing the real estate transaction, and escrow is the deposit of documents and funds with a neutral third party, along with instructions on how to conduct the closing. We're going to examine a closing for a residential purchase with a mortgage involved. The time involved between when the purchase agreement is signed and the closing typically runs between 30 and 60 days, 45 days on average. Prior to the closing, we have what's called the buyer's walkthrough. It's a final inspection of the property just prior to closing to make certain that the premises have been vacated, no damage has occurred, as well as testing of some of the systems in the improvement, testing the air conditioning system, the heating, and the plumbing. The walkthrough also determines that the seller has left behind personal property that has been agreed upon, and that the seller has not removed any real property. Why does this occur? Why is there a buyer's walkthrough? It's to make sure agreements regarding the condition of the premises have been kept. If those promises have not been kept, funds can be held at closing for certain repairs. Again, title closing is the process of completing a real estate transaction. It occurs when the buyer pays for the property and the seller delivers the deed. How does this closing occur? In the United States, there are two different ways in which a closing can occur. One is a closing meeting or settlement meeting, where the seller meets in person with the buyer and delivers the deed. An alternative is the closing in escrow. No meeting occurs with a closing in escrow. It involves the use of a neutral third party to carry out instructions of the contract. So let's first talk about the meeting. Who shows up at a closing meeting? Well, it depends upon the custom of that area. It could include the buyer, the seller, attorneys for each party, a representative of the lender, any real estate agents or brokers involved, and even maybe a representative from the title insurance company. Where does a closing meeting occur? Well, that all depends on the custom. It could occur in the office of a real estate agent, of an attorney, or even a title company. What are each party's responsibilities? The seller and/or his attorney must bring the deed and the most recent tax bill. And if required by the sales contract, the seller must also bring the insurance policy for the property, the termite and wood rot inspection report, deeds, or documents showing the removal of any unacceptable liens and encumbrances, title insurance policy, a bill of sale for personal property, a survey map, and any necessary offset statements or beneficiary statements. There may be some additional requirements if the property is a condo, a co-op, or planned unit development. In those cases, the seller would need to bring a copy of the bylaws and any restrictions. If the property is an income-producing property, the seller would need to bring any outstanding leases, any rent schedules, and a list of various expenditures associated with the property. The buyer must have adequate settlement funds ready, have an attorney present if desired, obtain the loan commitment if they are borrowing to facilitate the transaction. They must advise the lender of the meeting time and place. As mentioned earlier, the real estate agent may also be present at the closing meeting. The one who listed the property, they must make certain that the seller and the seller's attorney are prepared for the closing, and the agent who actually found the buyer must make certain that the buyer and the buyer's attorney are prepared for the closing. The settlement statement is an accounting of funds to the buyer and the seller at the completion of a real estate transaction. Before we move on to escrow, oftentimes a dry closing may take place. That's when all the parties sign their documents and entrust them to the person in charge of the closing for safekeeping. No money is disbursed and the deed is not delivered until the missing paperwork arrives. That may occur if everything is there except possibly a document or two, and the settlement meeting cannot be rescheduled. When closing in escrow, that is the use of a third party called the escrow agent who acts on behalf of both the buyer and seller to carry out instructions of the contract. This is very common out west. It does not involve any sort of meeting, so the buyer and seller do not meet. The closing is mostly done electronically or by mail, and hence no personality conflicts can occur. The escrow agent is selected by the buyer and the seller. The escrow agent must be bonded because they will be entrusted with various legal documents as well as with the funds associated with the transaction. Funds will be disbursed to the seller when the escrow papers are signed and the buyers send in the money. Some items to consider include delays and failures to close. If it's a relatively short time period, it shouldn't present a problem. However, if there are continued delays that are a very long time in nature, it might be best to mutually release both parties from the contract. Escrows can be used for something other than a conveyance, for instance, a refinancing. And in terms of reporting requirements, as we learned in an earlier chapter, that sales proceeds on real estate are reported to the IRS through Form 1099-S. The exception, we said, was that a capital gain less than $250,000 or less for a single person was exempt from taxation, and $500,000 or less for a couple, a married couple, is exempt from taxation. Prorating. There are going to be certain expenses and income items that need to be divvied up or prorated between the buyer and the seller. Some common proration items include hazard insurance, loan interest, rents on an income-producing property, property taxes, homeowners association fees. Usually a 30-day month will be used to prorate some of these expenses and income items, and the proration date, the date of closing, is usually the responsibility of the buyer, the new owner. Here's a graph of various common prorations. For instance, here we have a calendar year between January 1st and December 31st. One of the items that's commonly prepaid is hazard insurance. So the seller pays his premium for the entire calendar year in this instance. But the seller closes, the buyer and the seller close on August 15th. In this case, the buyer owes the seller for that portion that he will own, that the buyer will own the property, and the seller no longer owns it. Another example is an expense that's paid in accrual, property taxes. Property tax notices are sent out at the end of each calendar year for the year that's just transpired. So when the buyer receives a bill at the end of this calendar year, he gets the bill for the whole year, but he's only owned the property from August 15th through December 31st. In that case, the seller must compensate the buyer for that term in which he owned the property. Here's an example of a closing transaction summary. It starts with the sales price, reflects the down payment the buyer makes on the property, as well as the earnest money, how much of the seller's existing loan has to be paid off, how much the buyer took out in terms of a mortgage, and so on. Some of these expenses that are listed are going to be divided up between the buyer and the seller. That's due to the proration. But then there are going to be some items that don't need to be prorated, that are exclusively the domain of either the buyer or the seller. Furthermore, some items can be paid outside of closing. For instance, if you have an attorney present, you're going to have to compensate that attorney. You don't necessarily have to be paid, that attorney doesn't necessarily have to be paid at closing. It can be paid outside of closing. The closing disclosure form, which can be found in your textbook, is required for federally related lenders. It provides disclosures that will be helpful to consumers in understanding all of the costs of the transaction. And it replaces the old HUD 1 and Final Truth in Lending disclosure. The loan estimate form is a form where lenders, mortgage brokers are required to give potential brokers. They have to give them this new loan estimate form within 3 days after a borrower submits a loan application. It has to state the dates, terms of the loan, and any charges for the loan. This replaces the old Regulation Z forms and RESPA good faith estimate form. Well, what is RESPA? RESPA is a federal law, and it stands for the Real Estate Settlement Procedures Act. So this law deals with procedures that must be followed in certain real estate closings. Those closings include federally related first mortgage loans that are made for 1 to 4 family residences. RESPA says that no kickbacks are allowed, and fees can only be charged for closing services. It places restrictions on reserve accounts. RESPA also says that the buyer can choose the parties to the closing. Potential borrowers have to be given a booklet that's called a good faith. It's called Closing Costs upon your loan application. And of course, they have to be given a good faith estimate of closing costs. So again, RESPA is a federal law that deals with procedures to be followed in certain types of real estate closings. That's those real estate closings involving federally related first mortgage loans for 1 to 4 family residences. All third-party charges paid by title agents must be separately itemized and cannot exceed the amount paid to the service provider. There is another amendment to the rule that affects affiliated businesses. Participants in affiliated business are prohibited from requiring the use of an affiliated business. However, a settlement service provider may offer combined services at a price lower than the sum of individual services without triggering the required use concerns. If the use is optional to the consumer, the lower price is not made up by higher costs elsewhere in the transaction. Okay. However, RESPA also allows a right to cure. The rules given the loan originator the opportunity to cure any violation by reimbursing the borrower in any amount in which the tolerance has been exceeded. This reimbursement must be made at settlement or within 30 days after settlement. And finally, the very last step to complete closing is recording all of the appropriate documents. Here are key terms from this chapter. Any questions, please contact me.